Today's video is going to be about talking through the brokerage account with appreciated securities, meaning you've done the hard work, you've saved for years, now you're ready to retire and retire early, but you want to make sure that you can effectively and efficiently distribute the money from your brokerage account and fit it together with your larger financial plan. Today's video really has 4 sections. There's really 4 things you can do with these appreciations inside your brokerage account. Number 1, you can simply realize the gains. I'm going to show you how to do that tax efficiently and effectively in early retirement. Number 2, you can seek to mitigate those gains. I will go through what are the strategies and ways that you could seek to mitigate those gains as you approach early retirement or you've already begun it. Number 3, you can defer those gains, meaning you're not going to wipe them away, you're just going to move them forward for a later time. And number 4, you can eliminate the gains. Now, I've listed these in the most likely way that you would utilize them, meaning it's very rare that you can actually eliminate gains in an account, contrary to popular belief. So I've listed these in the most likely order that you will probably utilize them in your early retirement period. I am Forrest Dutton. I'm the owner of Brightworks Financial Planning, and I'm a certified financial planner, and I love to help people retire with confidence. So let's jump into this. Number 1, when I say realize the gains, so let's say that you're a diligent investor and you spent maybe the last decade investing in a handful of stocks, and you did a great job, and those stocks have gone up significantly, and you find yourself wondering, what will I do because I have gains inside this account, and how does that actually fit together with my early retirement plan? Now, for most early retirees, and I'm defining that as you retire before 59 and a half, the brokerage account is the first place that you're going to actually pull money in retirement. So there are certain amounts that you can distribute in gains, assuming those are long-term capital gains, where you will pay 0% in 2026. Now, that is going to be dependent on if you are married filing jointly or if you're a single. The married filing jointly amount is higher than the single amount, but the fact still stands that you can actually realize those gains, assuming that you are working together to figure out what your adjusted gross income is. If your taxable income is under a certain threshold, you can simply realize those gains and pay 0 taxes. Now, that is number 1. That is the most flexible and efficient way to do this, and most people watching this will have a period of time where you will seek to keep your income low for the purposes of paying 0% capital gains in that brokerage account. So, number 1 strategy, realize the gains. That's okay. For most people, that is the answer. But what if it's not? What if you have a more complicated situation? Let's move on to number 2. That is simply going to be mitigate the gains, meaning we know we're going to pay something on the gains. Is there anything we can do outside of our current brokerage account and our appreciated security in that account that can help mitigate the impact of those capital gains? The answer is yes. There are multiple things that you can do. So I'm going to start by just giving you a practical example. I had a client couple that recently retired, and prior to retirement, between 1 to 2 years before retirement, I was able to look at their full financial picture, and I realized that they had a concentration of a certain mutual fund in a brokerage or an after-tax account. So what we did was we took some excess cash and we actually put them in a type of account called a direct indexing account. Sometimes it's called a custom indexing account. All that means is you're going to own only individual securities. And I'm just going to use the S&P 500 because it's easy and most people understand what that means. So if you wanted to earn a return that mimics what the S&P 500 index would do, you could either own an index fund, which many of you are familiar with, but the index fund doesn't allow you to do anything in downtimes. So if you go through a bad quarter or 2 bad quarters or a bad year, your account is simply down the amount that it lost, but you have nothing to show for it. In a direct index, in that account, since you own the individual securities, what you can do is you can do something called tax loss harvesting, which means if a security loses value during that time, you can simply sell it, harvest that loss, and then buy back something that is substantially similar after 31 days to avoid something called a wash sale rule. Now, you could buy back the same security as long as it's after 31 days, because if you do that, they will disallow that loss. And you're asking, why would I want to sell something at a loss? Well, in reality, you're mirroring an index. So when the index is down, you're simply benefiting from that down period. You're going to get a similar return according to what your tracking error is of that index over a similar period of time. Now, if those losses do not have subsequent gains, meaning there are other securities that did not gain that you sold to either fund your income or your lifestyle, or just to take a distribution for buying something that you need or make a repair. If you did not do that, then those losses simply carry over. Now, the other question that you have to remember is those losses will continue to carry over, and you have a period over which you could decide to use those losses in whichever manner you wish. Now, why am I bringing this up? Let's go back to our retired couple. So to mitigate future gain that we knew we were going to have to sell out of this one mutual fund because they wanted to diversify at retirement, we created a second taxable account that was a direct index, and we were able to utilize periods of volatility in 2025. Now, again, individual results may vary. This is not saying that your investment results will be anything like this couple. I'm just telling you what happened. So in 2025, in the early first quarter, there was a big downturn in the market. We were able to harvest losses during that time, so that this year, when they want to diversify out of that other mutual fund that has big gains in it, those losses can help, again, mitigate. We still paid capital gains, but we were utilizing carryover losses so that the impact of that gain was much lower. It met their overall financial goal. Again, not meant to be personal financial or investment advice for you, but this is one way that you can mitigate gains. Okay, there's a second way that you can mitigate gains, and this one's really simple: gifting while you're alive. If you have a stock, and let's say that stock was $10 a share, and then it grew to $100 a share. If you wanted to give that, whether that was part of your overall strategy, say you wanted to even give it to a family member, the amount that they would have is called their basis. If you gave that stock to a family member, it would be as if they bought it for $10. So if they turned around and sold it for the current market value, which in our example is $100 per share, they would pay capital gains on the $90. But let's go back to our first scenario. Realize, if you know that you have a family member that you were going to give to anyway, this could be a child, this could be a grandchild, and that was part of your overall financial plan, this is a great way to mitigate some capital gains on your end. It doesn't eliminate them, because remember, the capital gains will just go to the next generation that you gave it to. But if you were in the 15% or the 20% tax bracket for capital gains, maybe they're in the 0% tax bracket for capital gains that are long-term in nature. That would be a win. That would be a way for you to mitigate some of that, and they could fill up their 0% capital gains bracket. So again, number one, realize. Number two, mitigate. Number three, defer. So there are a couple different ways to defer. One would be the structure of the account itself. By definition, if you have growth-oriented stocks that are not producing income and dividends every year, again, there's going to be some, but if the yield on that portfolio is very low, then you're not going to have forced capital gains distributions. This would just be an efficient way to utilize the portfolio. You're deferring those gains until you're the one who takes the money out. But more powerfully, if you have a portfolio that is not all the way concentrated, so this would not work with a single stock. There are many nuanced rules about this, but I at least want to bring it up, that if you wanted to diversify a portfolio that includes large positions, larger than you would like, you can do something called a 351 exchange. And that just basically takes your concentrated portfolio and it moves and seeds it into a new exchange traded fund. Now, I'm not going to go into the details of this. I think something like this might deserve its own video, but a 351 exchange is just a way for you to spread that out and diversify your portfolio, and then you can then later take those gains as you wish. So again, deferral, multiple ways to do it. Lastly, most powerfully but less common would be eliminate. So I got good news and I got bad news. You can eliminate your capital gains. That's the good news. The bad news is you have to die. So the best way to eliminate capital gains is to gift them to those you leave behind. Now, I know that sounds morbid and maybe not positive, but let's think about this for a second. There's a lot of talk around Roth conversions. I've done videos on Roth conversions. It's a very, very common topic that I have with clients. Dying and giving your assets through a brokerage account is almost like the anti-conversion. The basis will reset. So let's use our setting again. You bought this stock at $10. It went to $100. If you give that to your next generation, it's as if they bought it for $100. What happened to the $90 gain? The answer is it's gone. It's not realized. They don't have to recognize it on their taxes. So that really can be powerful, and this could be, in my opinion, almost like the anti-conversion. So meaning if you wanted to give money away, but you didn't want to hedge all of your bets on paying more or less lifetime tax with your other pre-tax accounts, you can simply set aside some brokerage account, portion of it, or even an entire brokerage account, so that you still get the benefit of giving that money to your heirs. Because if they wanted to sell it on day one before any appreciation occurred, by definition, it would be virtually tax-free. So that's one way that you can also eliminate. There's a second way you can eliminate. So again, like I said, you have to give up control in order to eliminate capital gains. The second will be you give to a donor advised fund. And that's simply a way that you can pre-fund giving. I often recommend that for those who are approaching retirement in their highest working year, meaning their last working year, because you can give, subject to certain adjusted gross income limits, it's an irrevocable gift to a fund that then will give you a large deduction in the year the gift was made. Now, the best way to give is an appreciated stock, because that capital gain, again, what happens to it? It goes away. The downside to this is you lose control of the money. So if you give it to a donor advised fund, it's a great way for you to give to organization of your choice, 501(c), or any other charity. So this would be a charitable gift. You give it one time, and you get the deduction on the front end, and then you can decide where it goes in later years. So to recap, I've talked through the 4 different things that you can do with appreciated securities in a brokerage account. Hope this was helpful. Please like and subscribe. This is how I reach more people. I would love to know what you think. Did I miss a category? Do you like the categories? Do you think these make sense? I would love to hear your comments, and I will see you on the next video. As always, this video is not meant to be personal, financial, tax, or investment advice.